Hey everyone, it's your guy here, coming at you straight from the chair in my studio. Today we are diving deep into one of the biggest geopolitical business stories of 2026. And trust me, this one has serious teeth, serious money, and serious consequences that are going to ripple far beyond Southeast Asia. Indonesia thought they could strong-arm Chinese companies and force them to give up the lion's share of their profits, technology, and equity. They kicked, they screamed, they made all sorts of threats, and what did the Chinese firms do? They pulled the plug, packed up every last piece of equipment, shut down entire production lines, and walked lock, stock, and barrel, like they were never even there at the time. A lot of pundits and talking heads said no big deal, just a few stalled projects, a couple billion in sunk costs, maybe some scrap metal lost. Who cares? But if that is all you see, you are completely missing the industrial domino effect. And I'm talking about a chain reaction that makes a house of cards look like solid steel. A mature production line is never just steel, wires, concrete, and flashing lights. Behind it, you have a trained workforce that took years, sometimes an entire decade, to build. With specific skills and institutional knowledge that you cannot just download from YouTube. You have long-term supply contracts that are now dead letters with legal claims flying everywhere. You have a full technical ecosystem of engineers, quality control experts, process chemists, and maintenance supervisors who all know exactly how to tweak the machinery for maximum output. And then you have hundreds of smaller supporting suppliers, machine shops, raw material brokers, specialized transport companies, cleaning crews, even the catering services that all revolve around that core plant like satellites around a planet. And more than any of that, you have the most fragile asset in all of global finance investor confidence. That is the invisible glue that holds the entire international trading system together. Indonesia's gamble looked simple on paper. They control over half of the world's nickel reserves, so they figured they could use that mineral chokehold to force Chinese firms to surrender majority equity, hand over proprietary process technologies, and basically become junior partners in their own factories while Jakarta sat back and collected the checks. What they did not count on was the Chinese companies calling their bluff without blinking an eye, walking away from billions in already spent capital and yanking their technology out just to protect their core intellectual property, even if it meant eating the entire equipment cost and writing off years of relationship building. Now, Jakarta is the one left holding the smoking bag. Factories are completely silent, highly skilled workers are standing idle with no paychecks and no severance. All those auxiliary suppliers are gasping for air like fish out of water, and the local governments that depended on those factories for tax revenue are suddenly staring at gaping holes in their budgets. Today, I'm going to break this down into 3 hard-hitting questions that every single American viewer should care about, because when a major resource player goes rogue, it ripples straight into global commodity markets, supply chains, and even the price you pay at the pump or for your next EV battery or for the stainless steel in your kitchen appliances. First, why did Indonesia go out of their way to squeeze Chinese investors in the first place? What was their real end game, politically and economically? Second, after that hardline, scorched earth exit, what is the actual price tag for Indonesia's economy, its workers, its fiscal stability, and its international standing? And third, and this is the absolute killer question, when a resource-rich country gets lazy and tries to skip the painful, decades-long grind of building real industrial capacity from scratch, do they end up torching their own economic future and permanently alienating global capital, or do they somehow get away with it? Spoiler alert, they do not get away with it. Let's get into the details, because the details are where the devil lives. Just last month, the OECD, the Organization for Economic Cooperation and Development, which is basically the club of wealthy, developed economies that set the tone for global economic policy, slashed Indonesia's GDP growth forecast for 2026 down to 4.8%. That might not sound like a huge drop to some of you, but in emerging market terms, that is a meaningful downgrade that signals real trouble ahead. And the report calls it exactly what it is: policy uncertainty through the roof, regulatory whiplash, driving investors crazy. And foreign direct investment drying up like a puddle in the middle of the Sahara for the average person scrolling through news headlines or catching a quick segment on cable television. Here is the money takeaway. What looks like a tough corporate exit is actually a giant, flashing warning sign about Indonesia's overall investment climate. Think about it from a pure business perspective, because that is how I look at everything. Chinese companies flew in with tens of billions of real hard US dollars. Money that could have gone anywhere on planet Earth, from Vietnam to Mexico to India to the United States itself. World-class facilities that were the envy of the region hired and trained local staff at premium wages and expected a stable, long-term return on that massive commitment. Instead, they got regulatory whiplash, tax breaks, and sweetheart deals one day, red carpets rolled out. Then the moment the plant goes live and starts generating serious cash flow, the government turns around and demands a 51% ownership stake, full access to their proprietary battery chemistry, and veto power over future technology transfers. Would any of you, as business owners or investors, put up with that for one single second? Of course not. You would pack your bags and leave, which is exactly what they did. Now let's run the real numbers because the math here is brutal. And I love me some brutal math, according to fresh 2026 reports from Standard & Poor's Global and BMI, both of which are widely followed by Wall Street banks' global commodity trading desks. And sovereign wealth funds, the global nickel market is not in short supply, it is drowning in structural oversupply. This is not a tight market where buyers are desperate. This is a market where sellers are fighting for every contract this year alone. We are looking at over 32,000 metric tons of surplus pressure hanging over the market like a dark cloud. And Indonesia itself is adding nearly 300,000 tons of new capacity every single year. That is new production that has to go somewhere. And right now, it is going into a glut. In a buyer's market like this, where Chinese firms have both the cutting-edge technology and the financial firepower to go anywhere they want. Why on earth would they bend over backward for a jurisdiction that changes the rules on a whim, threatens outright expropriation, treats foreign capital like an ATM with no withdrawal limits, and shows zero respect for signed contracts? And here's the knockout punch that a lot of mainstream media outlets are completely missing. China's own domestic technology is advancing so fast that its dependency on nickel imports is shrinking in real time, month by 2026, homegrown giants like BYD and CATL, both of which are global leaders in battery production, have already commercialized sodium-ion batteries and cobalt-free batteries at industrial scale. And they are ramping up production as we speak. These new chemistries use far less nickel, or in some cases zero nickel, which means the strategic importance of Indonesian ore is declining, right when Jakarta thought they had all the leverage. So when Chinese companies pulled the trigger and dismantled their lines, it was not out of rage or pride or some kind of nationalist temper tantrum. It was a cold, calculated, spreadsheet-driven business decision because their industrial base is so solid and their technology is so advanced that they simply do not need to beg for nickel from an unreliable partner who cannot keep their word. In Indonesia, they are not even trying to hide their game anymore, and that is what makes this so galling. You might ask yourself, why would a rational government, with all the best economic advisors money can buy, trash a perfectly good win-win partnership and scare away the very investors they desperately need to fund their ambitious development plans? The answer is their so-called downstreaming national strategy. It sounds fancy in policy papers and press releases, but it is really just a transparent shortcut to skip decades of painful industrial development, infrastructure building, worker training, and research and development investment that every other successful industrial economy has had to go through. They want to leapfrog straight to the finish line and harvest the high margin, fully built out supply chains that Chinese companies spent years and billions of dollars creating from scratch. So they dangled huge incentives, smiled for the cameras at groundbreaking ceremonies, waited until the factories were humming, the local workers were fully trained, and the profits were flowing into government coffers through taxes and royalties. Then they pounced like a predator, demanding majority stakes, board seats, and detailed technical blueprints that took Chinese engineers a decade to develop. Come on, does that sound like a fair deal to you? Or does it sound like old-fashioned extortion dressed up in bureaucratic language? I know which one I would call it. Why are they so brazen about all of this? Because they have the ore, and they know it cold. Since 2023, Indonesia has produced more than half of the world's nickel output, and that market share has only grown by 2026. They figured that mineral monopoly gave them the leverage to strong-arm any foreign investor, regardless of the contracts they had previously signed or the international arbitration clauses those contracts contained. But that is only half of the motivation. I dug into their latest fiscal reports, and the picture is absolutely staggering. Even by emerging market standards, by 2026, Indonesia's total budget expenditures have exploded like a balloon that is about to pop. with overall spending surging over 34% year on year in the first few months alone. Where is all that cash going? Half of it is being burned on a brand new mega project capital city being built from scratch in the middle of the jungle, a project that is already over budget and behind schedule. And the other half is financing a nationwide free meal program that is mind-bogglingly expensive to administer, procure, and deliver to millions of school children across thousands of islands. The latest official allocation for just that meal plan is 335 trillion Indonesian rupiah. And when you convert that at current exchange rates, which are already under pressure, it is close to 20 billion US dollars, $20 billion for one single social program. Their fiscal deficit is ballooning. Their debt service costs are rising because global interest rates are still elevated. And instead of building sustainable revenue through normal taxation, economic growth, and industrial expansion, they figured the fastest, easiest fix was to suck the lifeblood out of mature foreign invested projects that were already generating hard currency and steady tax payments. Add to that the global EV demand slowdown as of July 2026. The pie is no longer growing as fast as everyone predicted just a couple of years ago, so they decided to fight over the existing slices instead of baking a bigger cake. They targeted the golden goose, the goose that laid the shiny nickel eggs, but they completely underestimated the backbone of Chinese firms, which are often state-backed, have long-term strategic horizons, and are willing to take short-term losses to protect their long-term interests. They would rather dismantle every single piece of machinery, crate it up with meticulous care, ship it back to China by the container load, and reassemble it elsewhere than hand over their hard-won competitive advantages to a partner that has shown it cannot be trusted. And that exit, it is not just a few machines on a cargo ship. For Indonesia's ordinary people and its broader economy, it is a gut punch, and I mean a broken rib. Collapsed lung, internal bleeding, multiple surgeries kind of gut punch. Let's tally up the three biggest costs because these numbers are going to make your head spin, and I want you to really feel the magnitude of what is happening here. Cost number one, the industrial chain collapse in the direct. Brutal hit on Indonesia's foreign trade backbone. With the Chinese pullout, Indonesia is facing an annual export loss of up to $23 billion in nickel products and related downstream materials. That is not a rounding error. That is a massive chunk of their total export earnings, to put that in perspective. Indonesia's official 2026 fiscal deficit target was capped at 2.68% of GDP. That was the line they promised international creditors they would not cross. But new market warnings from independent financial analysts show that because of cratering tax revenue and export shrinkage, that deficit is already spiraling toward 2.85%. And that is a conservative estimate that assumes no further deterioration. That fiscal safety cushion just got razor thin, and the government is going to have to make brutal, painful choices. Cut spending on infrastructure, raise taxes on a population that is already feeling the pinch, or borrow at punishingly high interest rates from international markets that are now demanding a risk premium for lending to Indonesia. None of those are good options for the average Indonesian family. Cost number two is even nastier and more visceral because it is about real people and real livelihoods. A full-on jobs bloodbath that is going to leave deep social scars. When the Chinese core plants shut down their gates and locked them for good, thousands of well-paid local technicians, engineers, line supervisors, and quality control specialists were laid off literally overnight. No warning, no transition packages. Just a pink slip and a handshake, but that is only the tip of the iceberg, the visible part of the disaster. The ripple effect is absolutely massive. Entire logistics fleets that moved raw materials and finished goods from the plants to ports. Power suppliers that ran dedicated substations and transmission lines, small machining and maintenance shops that did custom fabrication and repairs, even the food stalls, convenience stores, and street vendors outside the factory gates that depended on the daily foot traffic of thousands of workers. All of it cascades downward like a rock slide. The most widely cited estimate from local business associations now is that this directly and indirectly affects over 400,000 jobs across the local economy. That is 400,000 households wondering how they will pay for rent, food, school fees, medical bills, and transportation. That is not a statistic you can just shrug off. That is a social powder keg that could explode into protests, strikes, and political instability. Cost number three, the hollowing out of national reserves and the rapid erosion of Indonesia's financial firepower on the global stage. I checked the latest official data released at the end of June 2026. Indonesia's foreign exchange reserves had already shrunk to around $145.6 billion. That sounds like a massive war chest, something that would make most countries envious. But in reality, it barely covers about 5.5 months of import cover, which is dangerously close to the internationally recognized comfort zone of 3 months. Now, they have just taken a sledgehammer to their own best dollar earning industry, the very industry that was feeding those reserves. That is a death blow to their foreign currency liquidity. And I am not exaggerating. You and I keep a rainy day fund for emergencies, a few $1,000s, maybe a bit more if we are prudent. A country without steady foreign exchange inflows simply cannot buy critical imports, oil, natural gas, grain, medical supplies, industrial components, technology licenses on the global market. This is not theoretical. It is going to hit supermarket shelves, hospital supply rooms, and factory floors in real time. And the effects are going to be felt by every single Indonesian citizen, from the poorest farmer to the richest tycoon. Now, if losing factories and jobs is just a flesh wound, what comes next strikes at the very foundation of the Indonesian state: sovereign credibility and the trust that underpins all international commerce and finance. It takes decades, sometimes entire generations, to build a reputation for enforcing contracts, respecting property rights, upholding the rule of law, and treating foreign investors with decency and predictability. And one single act of blatant cynical betrayal can tear it all down in a week. Or even a single trading session. Indonesia, for the sake of a few $billion in assets that they tried to grab through coercion, has torched the international community's faith in their legal system and their regulatory stability. Capital is smart, but it is also profoundly, almost pathologically cowardly when foreign institutional investors, pension funds, sovereign wealth funds, mutual funds, endowments see a government that pulls the rug out from under a major player like China without any real consequence. They immediately start asking the most dangerous question in finance: are we next? And they do not wait for the second shoe to drop. They do not wait for clarification or diplomatic reassurances. They sell first and ask questions later. Here is a jaw-dropping number that should be on every financial news ticker and every cable business show right now. As of the day we are recording this video, the Indonesian rupiah has plunged past 18,000 to the US dollar, with some major banks quoting the sell rate at 18,150 rupiah per dollar. That is a full-blown capital flight signal, plain and simple, the kind of currency move that keeps central bankers up at night. Everyone with any sense is dumping rupiah assets and converting to dollars, euros, Swiss francs, or even physical gold. The central bank is burning through its foreign reserves in a desperate attempt to prop up the currency through massive market intervention. And they are losing that battle, losing it badly. The stock market is even bloodier. Foreign selling is so intense that the Jakarta Composite Index has tanked over 30% year to date, making it the worst performing financial market on planet Earth in 2026. No contest, no runner-up, no honorable mention. It is dead last. Let's do the quick math here, because this is the irony that absolutely kills me and should kill you too. Jakarta fights tooth and nail, uses all their political capital and diplomatic muscle to snatch a few $1 billion in physical factory assets, maybe 10 billion, maybe 20 billion at most. But the capital markets, in a single trading session, wipe out hundreds of billions of dollars in market capitalization and portfolio value. It is like burning down your own house to collect the insurance money, only to find out the policy was void because you set the fire yourself. And who ends up footing the final bill? Who pays the piper? Ordinary Indonesian citizens. That is who a collapsing currency makes every single imported good more expensive in local terms. Food staples like rice and cooking oil, fuel for cars and trucks, medicine for hospitals, machinery, parts for the factories that are still running. Everything. And with global energy prices already elevated due to geopolitical tensions and supply chain disruptions, that imported inflation is going to eat families alive, bite by bite. The OECD now projects Indonesia's 2026 headline inflation rate at 3.4% on an annualized basis. But if you look at local market reports from Jakarta, Surabaya, and Medan, the real price increases for rice, cooking oil, and other daily necessities are already hitting double digits in some areas. That is the kind of inflation that sparks street protests, empties government buildings, and brings down cabinets. So here is my bottom line And I want to be crystal clear. No ambiguity, no weasel words. I have always said. And I will keep saying, resources are finite. They run out eventually no matter how rich your soil is, no matter how deep your mines go. But technology evolves, iterates, improves, and compounds every single day. Indonesia's fatal miscalculation was a complete and utter lack of patience for the long grinding, often thankless work of industrial development. They wanted the rewards without the sacrifice. They wanted the champagne without the vineyard work. If you are a resource-rich country and you think you can just monopolize ore deposits, impose pirate-style terms on your partners, ignore basic contract law, and expect the world to keep doing business with you as if nothing happened, the global supply chain will eventually drop you like a bad habit. And that is exactly what is happening right now. In real time, the chilling effect is already visible in the data. Chinese firms have put $300 billion in existing Indonesian investments on full strategic ice. Not canceled yet, but frozen solid with no new capital flowing in and existing operations being wound down or put into care and maintenance mode. Another $20 billion in new projects that were in the pipeline with feasibility studies completed and construction contracts ready to sign are now effectively frozen indefinitely. Not canceled, but suspended until further notice, and that notice is not coming anytime soon. That money is not disappearing from the global economy, not at all. It is rushing toward jurisdictions with stronger legal frameworks, more predictable policy regimes, and a track record of honoring agreements. Vietnam is licking its chops. Malaysia is rolling out the welcome mat. Mexico is offering incentives. Even parts of Eastern Europe are positioning themselves as the new manufacturing hubs for companies fleeing regulatory chaos. That is risk aversion in its purest, most rational form, and it is completely justified. And look at the broader global landscape as of July 2026. Global supply chains are restructuring at warp speed, driven by trade tensions, shifting tariff regimes, the ongoing decoupling between the United States and China, and a general sense that the old certainties are gone. At board meetings across the Fortune 500 and major European, Japanese, and Korean conglomerates, policy stability now routinely ranks ahead of resource abundance on the investment checklist. CEOs and CFOs are asking, is this country going to change the rules on us after we spend 5 years building a plant? And if the answer is even a maybe, they walk. Indonesia's stunt has scared not just Chinese firms, but also European, Japanese, Korean, and yes, American companies that were eyeing a China plus one hedge to diversify their manufacturing footprint and reduce their exposure to any single jurisdiction. Even the United States, my country, is in full pullback mode. Our current president keeps hammering on protecting domestic industries, renegotiating trade deals, and bringing manufacturing back home through tariffs, tax incentives, and regulatory reform. Multinationals are already on edge because of tariff uncertainty and supply chain disruptions that have been building for years. When they see a major resource player like Indonesia blatantly and shamelessly rob a strategic partner like China, why would they park their billions of dollars in a place that changes ownership rules overnight with no compensation? So now, everyone from Wall Street to Tokyo to Frankfurt to Seoul is looking at Indonesia with a giant, blinking caution, high-risk sign, and that perception will take a generation to repair if it ever can be repaired at all in the long run. And I mean the really long run over the next 10 to 20 years. This is not about one or two factories or even a few billion dollars in lost investment. This is about the entire technology gap race that is reshaping the global economy. Without continuous Chinese technical support, training programs, process optimization, and supply chain integration, Indonesia's remaining low-end smelting capacity will quickly become obsolete in a global market that demands higher purity, lower costs, greener production, and more sophisticated alloys. In 2026, when solid-state batteries, sodium-ion alternatives, lithium iron phosphate chemistries, and even completely new battery architectures are reshaping the entire electric vehicle industry. If all Jakarta has left is raw ore and no processing innovation, no research and development pipeline, no skilled engineers, they're much hyped, much advertised dream of becoming a powerhouse, a global leader in battery metals and downstream processing, is going to turn into a complete and total mirage, a castle built on sand that washes away with the first high tide. And let me leave you with one final thought, because this is where it gets deeply personal for every single American viewer watching this video. When a resource giant like Indonesia implodes its own credibility, the global commodity markets get more volatile. prices swing more wildly on a daily basis. And the cost of raw materials for everything from electric vehicle batteries to stainless steel kitchen sinks to aerospace alloys becomes harder to forecast. That uncertainty gets passed right down to the consumer, to the price of your next car, to the cost of building a new home, to the stability of your 401k if you have any emerging market exposure in your portfolio, to the inflation rate that the Federal Reserve is constantly fighting. So this is not some faraway drama happening on the other side of the world with no connection to your life. It is a live case study, a real-world experiment. In what happens when governance fails, greed overrides common sense, and short-term political expediency trumps long-term economic sanity, the Indonesians made their bed, and now they are lying in it, but the rest of us, including Americans, are going to feel the tremors for years to come through higher prices. More volatile markets and less predictable global trade, all right? That is the unvarnished, no bull truth for today. Straight from the chair, no sugarcoating, no spin. I hope this gives you a real, grounded, no fluff understanding of what is going on beneath the headlines and behind the press releases. Drop your thoughts in the comments. I read every single one of them, and if you want more straight talk on global trade, supply chains, geopolitical chess moves, and the financial crosscurrents that affect your wallet, hit that subscribe button and turn on notifications. I will catch you in the next one. Peace and stay sharp.